Awesome. All right, Paul Rees, it's great to have you. It's a pleasure to have you on the podcast today.
I appreciate it. And, thank you for inviting me. I definitely appreciate it.
Of course. And welcome back, everybody, to Sharpe Minds. I am your host, Michael Lafata, and greatly appreciate everyone taking the time to listen to the show and hearing what we have to say. I hope everybody's prepared because Paul is, really about to instill some knowledge on all of us, and I'm really looking forward to it. We have a lot on the dock today. Paul, we already, started talking about a couple things. And before we really dive into it, just want to give you a good intro, and then we'll get rolling.
Great.
So you are an executive vice president at PIMCO, and you're located at the Newport Beach office. Your responsibilities span across a variety of PIMCO's fund lineup. These portfolios are the total return, the global, the income, dynamic bond, the enhanced cash strategies. In addition to this, you're responsible for municipal bonds, emerging markets, and ETFs. This is great because definitely want to spend some time covering both the muni and the emerging market space. I think it's a good time to touch on both of those. And then most impressive of it all, you have 40 years of investment experience, 25 of which have been with PIMCO. And if that wasn't impressive enough, you're also a licensed CPA, which is super cool.
Yeah, I've done a lot over my career.
Yeah. Do you think
Spanned a lot. Yeah.
Do you think having that CPA gives you like a unique lens, in addition to like a standard, finance lens that you see things through?
It does because when I was in school, I thought about what about just building foundation and foundational knowledge. And I wasn't sure which direction I would go. Would it be, let's say, as a credit analyst? Would it be, more of like a traditional accounting role? Would it be something that's investment related? But I just thought it was a really good foundation. And so then when it comes to evaluating what's going on in the economy, you have this logical flow and progression. And it was a really good way to set myself up for the future, really.
Mm-hmm. That's awesome. No, I think that's great. It's not something that I think you see that frequently. So it's definitely something that, you've used to your advantage, and that's awesome. The PIMCO is a really great firm. They're the 800-pound gorilla in the fixed income world. Started by Bill Gross, many decades ago. And what's your experience been like so far? You've been there for a long time, and how's that experience been? And tell us a little bit about that.
Yeah, it's been, and honestly, I can't believe that I've been here 25 years. It's been a great place to work, just in terms of the collegiality, the people that I work with who are all, incredibly smart, that have a lot of experience on Wall Street, just a variety of experiences. And it's also, foundational. What we were built on is our macro view and how that drives the investment process. And that wasn't my training, or wasn't a part of my training before I started here, although I was interested in the markets and economics and had touched upon them. And so it's really been a great road in terms of just being able to get much, much more involved in the markets.
Mm-hmm.
And then on top of that, just having the prior experience before I started here, this is really an entrepreneurial firm. Even though we may be the 800-pound gorilla, really, if you have a good strategy that maybe isn't out in the market, or there's, let's say, a gap in our lineup, you have the freedom to really work on that, work with our portfolio management team, work closely with our account managers, and then work with our clients to develop solutions. So it's been a really great place to be. And there's always something new to do every day.
Yeah, for sure. One of the interesting things you touched on was the firm-wide views. And I know, you guys have many different views, right, in house amongst many different strategists, many different portfolio managers, what have you. But then at the same time, you all come together and you build a firm wide view that you move forward with, explain to clients and so forth. Tell us a little bit about that process and how you guys get there.
Okay. Yeah, really the foundation for our investment process is our economic forum process.
Hmm.
And the idea behind it, we meet 4 times a year. 3 times it's looking at that 6 to 12 month view. The fourth time is looking out about 3 years. And what we're trying to do is, from a top-down perspective, and you're right, we have a variety of views, but
Hmm.
come up more of like a consensus view or a baseline so that you take some of the emotion out of investing
Hmm.
because there are day-to-day fluctuations and you can take advantage of them. But really, that's the foundation for how we develop our portfolio strategies. And yesterday was a good example of that, where we had our March cyclical forum.
Hmm.
And this is looking out 6 to 12 months. The general theme right now is just uncertainty is certain. It's pretty much guaranteed there's going to be a lot of uncertainty in
Yeah.
this type of environment.
Yep.
And from a top-down perspective, how does that influence the way we're investing portfolios and how do we set up our
Hmm.
investment strategy? This is something that when the firm was founded in 1971, it immediately became a part of our investment process. We, over time, have refined it, and we have a global advisory board where we have dignitaries from the outside that provide input. We've incorporated behavioral science. So we've done a number of things over the years to enhance the process. But you also have the bottom up. So we have
Hmm.
resources across the board. When we're managing credit, we have a huge team of credit analysts. If we're managing munis, the same. If we're managing emerging markets, the same. So it's that combination of top down and bottom up. But really, again, the key is when you have that top down approach and you're looking out over longer timelines,
Hmm.
it takes away some of the emotion that you have in the market and you can continue to implement that strategy. And then when you see dislocations because of the noise or because of what's happening in the near
Yeah.
term, advantage.
I think so. Two things you touched on right there that I think are really interesting: the uncertainty is certain, and then the dislocations. But for the first one, did we? Do you guys think that we got more clarity around some of that uncertainty over the past, couple days with the announcement of the tariffs, and just seeing how the markets have reacted to that? Because, in my opinion, right, that was one of the big uncertainties coming into this year, right, and over the past couple months was we didn't really know what that was going to look like, and now we have more clarity around that. But does that provide more clarity into how we should move forward as investors, or capital allocators, however you want to think about it?
Yeah, what's interesting about it is that we are living in an uncertain environment, and we created a baseline view, and that is as a starting point
Hmm.
that inflation, although it's somewhat under control, it's going to be in that 3% kind of range.
Hmm.
And but it was unclear, is it going to be, it's in a range, is it going to drop down closer to the Fed's target of 2%?
Hmm.
GDP growth, strong initial conditions going into this environment, even going into the pandemic, we had strong initial conditions. And so GDP growth has been slowing down modestly, but because of those strong initial conditions, somewhat stable. And so when you combine those two, you take the top down and you say, okay, GDP growth is slowing down ever so slightly, but not enough for the Fed to cut rates. Inflation continues to hover in that mid 2 to 3% range, but again, not quite dropping. This did provide some clarity in terms of just Fed policy and the impact. And so it takes that baseline view and then it can shift it slightly in different directions. But our general view was that well, if you went back 6 months ago, we'd say that the Fed was on a path to cut rates this year. Now, because
Hmm.
of economic strength, we'd say, well, they may at the tail end of this year have a couple of rate cuts. But the last couple of days, the last couple of weeks have provided a little bit more clarity.
Yeah, it's this year's really interesting because there's so much uncertainty coming into it. So that really is, and for me in particular, when I think about it, I currently see more uncertainty today. Maybe it's a little bit more clear over the past couple of days because of the announcements. But just in general, like you mentioned, rate cuts. 6 months ago you were thinking we could get some rate cuts. It doesn't look like we might get any this year. Do you guys have an opinion on that? Well, while we're on that topic.
Yeah, so our view, at least right now, is that there's enough economic strength that it really rate cuts aren't completely off the table.
Hmm.
Now, the tariff announcement today or the implementation of tariffs today, going into this week, the question was, are tariffs a bargaining chip or are they going to be a battering ram? And, will Canada, Mexico, and China cave in, or is this just opening it up so that you can bargain with them?
Right, right.
And they're creating enough uncertainty where we'd say on the margin, if when they're implemented, the other thing that was a surprise is that there was an announcement of immediate retaliation tariffs from the other side.
Yeah.
So what does that lead to? Well, it definitely leads to a potential increase in
Hmm.
inflation. From Canada, it's timber, natural resources, steel, aluminum. From Mexico, it's manufacturing. From China, it's more cost of goods. At the same time, so what does that do? Well, it increases inflation, reduces growth, and on the margin, at least with tariffs being implemented, it reduces
Hmm.
the deficit. And it created potential for trade wars. So there's more clarity there. Even then, you never know what's going to happen over the next few weeks. It may
Hmm.
be that it was more of a bargaining chip, and then the trade war suddenly, instead of being elevated, it starts to, let's say, become a little bit, uh, you know, le it has less of an impact.
Hmm.
Um, so that's something that, definitely created more clarity for us. And then it's just a matter of, did it fit within our baseline view?
Hmm.
Yes, but it ends up being, let's say, more on the extreme end of it.
Can we walk through, just for the people listening, why tariffs are inflationary? Because on the surface, and maybe they are, but they sound like it sounds like a decent idea, right? Try to bring some stuff back to the U.S., bring some manufacturing back to the U.S. Let's produce a lot more things. Um, can you just walk through the process of why we could see some inflation as a result of this?
Yeah, so the reason that they're inflationary is first, the purpose of a tariff really is, as you said, to bring manufacturing or
Hmm.
to bring jobs back into the US. Where it becomes inflationary is that if you are importing goods, then the tariff, usually that translates into a higher price because whether it's Canada or any country where we're importing goods from them, they most likely will raise the price to cover the tariff. So for consumers in the U.S., that means higher prices.
Right.
The other piece of it that's inflationary is that the cost structure here for U.S. companies is higher than it is for companies outside the U.S. That was
Hmm.
one of the purposes of having manufacturing or importing goods because they are less expensive.
Hmm.
So that can also drive up pricing here. Then if you have a trade war, that also drives up pricing. The reason that it reduces the deficit is this is like a tax, or
Hmm.
it's similar to a tax, and so it's increasing government revenue. But at the same time, because prices are higher, that means that the consumer and corporates may spend less, so that can lead to a slowdown in economic growth.
Hmm.
Those are the general characteristics, and then it's just a matter of how all of that kind of plays out.
Do you do you think we'll see a slowdown of the consumer because of this? I mean, and the reason I ask is because we haven't seen that over the past couple of years, right? A couple of years ago, inflation was triple what it is today, and people were still spending money like crazy. And you can argue that they had more savings from stimulus at that time, and maybe some of that stuff. But I think in general, I just don't know. Maybe I'm being naive. I just don't know what's going to cause people to stop spending money, especially if you have the summer coming around. A lot of good stuff to look forward to. What are your thoughts there?
Yeah, it just in terms of what we've seen, it will lead to a ever so slightly economic slowdown,
Hmm.
but it doesn't lead to a recession.
Yeah.
And so if you look at GDP growth, it's been in about the 2 to 3% range. And our view is that that might drop slightly to 1.5 to 2%. But that's still economic growth. And you mentioned it, you have strong initial conditions. So the economy was strong going into the pandemic.
Hmm.
That was 5 years ago, but still,
Yeah.
the economy was strong leading into the pandemic with the stimulus money that came in for consumers as well as keeping corporate stable.
Hmm.
That although much of that has been spent, it also meant that savings were relatively high. And the consumer balance sheet as well as corporate balance sheets have been cleaned up. In terms of, and this is something that's it's global in nature, but in terms of stability, um, let's look at mortgage rates during the pandemic. They
Hmm.
dropped all-time lows. And in the US, for the most part, you have 30-year mortgages. So for anybody that bought a new house, refinanced during that time period, it actually created stability for them because that really reduced the affordability of housing and
Hmm.
reduced their expenses. And as an aside, I experienced that. About 4 years ago during the pandemic, I bought a house and it was affordable and my interest rate is incredibly
Yeah.
low.
Yeah.
So I'd say for a cohort of consumers, and consumers are a little over 60%, two-thirds of the economy. Um, for a cohort, fairly stable. The other thing is GDP growth last year, at the end of last year, was a little bit higher than usual or a little
Hmm.
bit elevated. And the reason for that is that many were front running the tariffs because of the uncertainty.
Mm.
And so spending in advance. Unemployment's low, dropped to about 4% most recently,
Hmm.
and new jobs are still being created. So when you factor all of that in, you'd say, well, yeah, economic slowdown is in the works, but it's modest. And then I'll throw in one more piece of it, and that's just immigration and the impact that that has on economic growth. And that is that it actually opens up more jobs. It does reduce GDP slightly. There is less spending, but at the same time, just by reducing immigration, that also does lead to a slightly slower economic growth. But again, not recessionary.
Hmm. So to summarize that, you think we're in a decent spot to, handle, a rise or potential rise in prices, from a tariff situation, um, and you still see the consumer in a decent spot, and another thing I think the most important thing that you mentioned is mortgages, and I don't think it's something that people really think about. At least some consumers when they think about this is so many people have their mortgage financed in low single digits, and maybe I'm not a good enough, steward of history, but I don't think we've ever had a period of time where this many people have had, their largest debt financed at such a low rate. And that really does change their mindset, changes their spending habits, changes everything.
Yeah, it really does. And to give you an example, when I bought my first house, the initial mortgage rate that I had was over 10%.
Wow.
And then I've gone through a cycle where it just kept getting lower and lower. And then we had the financial crisis. Even then, during the financial crisis, mortgage rates weren't as low as they were during the pandemic.
Hmm.
But to your point, it does create, I'd say, some stability when you know that assuming that someone hasn't stretched, that they can afford the mortgage payment, that um, they are going to stay in their home. That's actually one of the reasons that real estate prices have increased the way they have, is
Yeah.
that you're not seeing the same kind of supply that you saw in the past. And someone's not going to move from, let's say, a 2.5, 3% mortgage rate to something close to 7%. So there is some stability there. Um, but yeah, it does change the mindset. I still think, and I'm curious about, what your clients have said to you, but it, the uncertainty is creating, some issues for people. They just want to take less risk.
Hmm.
Uh, but at the same time, there is some comfort or stability in the fact that you can, if you were able to buy a house
Hmm.
during that time period, that there's some stability there and some comfort in that.
Yeah, it is interesting. We've seen a noticeable uptick in clients who want to remain invested. They want to have market exposure, but they're coming to us and they're saying, with new money, and they're saying, hey, I'm thinking about doing a dollar cost average, over the next 6 to 12 months. Take advantage of some of the volatility that we'll have this year, or that we might have this year. And that's an interesting thing because clients are coming to you and with the understanding of 23 and 24 were pretty non-volatile, right? We didn't have a lot of volatility in those years, and whether we see it or not this year is another story. But the possibility of having more volatility this year is certainly higher than it has been.
Yeah, it definitely is. And that, as investors, we kind of look at it as it does create opportunities.
Hmm.
And it, like when I think about just overall asset allocation, and when I looked at more recent industry flows, I've seen a significant amount of assets flowing into cash or money market like strategies.
Hmm.
Not as much. We would say, from a yield perspective, once the Fed started to raise rates, it made fixed income and bonds more attractive.
Hmm.
At the same time, when you have that uncertainty, investors really aren't sure, which way they should go. So we it'll be interesting to see if investors are doing some kind of dollar cost averaging.
The money market's extremely interesting. What we've seen there over the past couple of years is really interesting to see. And something that surprised me is money still flowing there. I mean, it wouldn't be surprising to see that, like right now, right? If we saw that start to ramp up again right now, that wouldn't surprise me. But the fact that money has continued to flow there over the past, 6, 12, 18 months, while we've had a really non-volatile market that, has pretty much just gone up and to the right. It's really been interesting to see that take place.
Yeah, and I guess really when there is a lot of uncertainty in the environment, we've seen assets shifting from equities into fixed income or into money markets. And I do look at flows just to try and, industry-wide flows, just to
Hmm.
get like a big picture of what are investors potentially thinking.
Hmm.
And I'll give you an example.
Yep.
So my mother's in her 80s,
Hmm.
and she she's conservative to begin with in terms of how she's investing. Uh, but at the same time, that all of this has created a lot of uncertainty. She's not working, but when she thinks about, or when she sees the headlines and all of that volatility, I'll get, calls. She doesn't really
Yeah.
email. So it's more like a phone call. Just about what do you think, what's going to happen? Um, a little over a year ago, when you had the banking crisis, her question was, should I pull all my money out of the banks? And, my answer was, no, the banks are, you're with a large bank, it's fine. There's,
Hmm.
deposit insurance, don't worry about it. But she's only one data point.
Hmm.
But if others are thinking that way, then, that would be one of the reasons that they just take money off the table and move to money markets. At the same time, especially today, if you look at and I know this is just one day, but if you look at what's happened with the 10-year yield, it dropped from about 4.5% down to about, when I last looked, it was about 4.15%.
Hmm.
And policy rate is just about equal, which means right now, if you were in fixed income leading up to this, you picked up some nice capital appreciation,
Hmm.
but now the yield curve is flattened, and so there are going to be investors that'll look at money markets and say, "I'll just stay here for now."
And I think you bring up a really good point, though, because with your mom, because that generation holds a lot of the assets that are coming into the markets today. So yeah, it's one data point, but there's a lot of there's trillions and trillions of dollars within that cohort of investor that if they continue to if we continue to see this uncertainty, they're not moving. They're going to stay and collect their 4% or so, and they're just going to hang out, and it's not going to bother them at all.
That's right. And really, they focus more on downside risk,
Yep.
eh, just making sure that there's stability there,
Yep.
versus others that would say, well, fixed income does look attractive, yields are attractive, there are a lot of interesting areas that you can invest in, and as interest rates fluctuate like
Hmm.
this, it creates opportunities and dislocations. But also, if you see rates fall as they did over the last couple of weeks, that increases
Hmm.
bond prices. So that's the only thing that if someone's sitting in money markets, that's what they miss out on, is just that opportunity
Hmm.
cost of picking up some capital appreciation.
Right, right. The dislocations was the other thing I wanted to come back to that you mentioned previously. What are some of those dislocations that you guys are seeing in the markets today? And let's talk about that a little bit.
Okay. Yeah. So one thing that's interesting, and this is it's a piece, a PIMCO perspective piece that came out in February. Mark Seidner, who's our group CIO of alternative strategies, and Pramal Dewan, who's the head of our emerging market desk, they just wrote about um, when risk assets look expensive and they're
Hmm.
priced for perfection. Title was priced for exceptionalism, but I think of it more like priced for perfection.
Yep.
And so the sectors or the areas of the market that look, at least to us, that look a little bit more expensive are equities. When you look at the cyclical price earnings ratio, it's really reached, it's not an all-time high, but it's well above historical averages. So what does that tell you? Well, price earnings, that means that price in equities is somewhat elevated versus earnings, so it's expensive.
Hmm.
When you combine that with the trade policy uncertainty, which is really at a peak, that would lead you to believe, especially in fixed income,
Hmm.
that you should be paid more of a premium for taking on risk. And yet, then when we look at um, spreads, so let me I'll define what that means. If you just look
Yep.
at fixed income yields, and you look across the board, they're really attractive and they're high. And so you'd say, hey, if I can earn 8 or 9% in high yield or 8 or 9% in emerging markets, that's great. That's what I want.
Hmm.
Then you look at spreads to treasuries. Am I being compensated to take that additional risk versus investing in a treasury, which is a government guaranteed bond?
Right.
Those spreads are relatively tight. And so what we're looking for are dislocations there because what we're doing today across our portfolios is we're up in quality, we've increased our liquidity,
Hmm.
we're investing more closely to government issued or in government issued sectors and securities because we don't have to take a lot of risk. And it's by doing that, fixed income is a good diversifier with a low correlation to equities. So
Hmm.
if equities are selling off, fixed income should perform well. But in the riskier sectors, you're not getting that same kind of compensation. And
Yeah.
so the correlation in, let's say, high yield versus equities it's much higher.
To provide some context, what has that credit spread historically, what's the range historically been? Um, and you kind of provided good context around what it is today, um, but compared to historically how that's traded, what does that look like?
Yeah, it's a couple hundred basis points within. We I don't have it or I can't post it, but we have a
Yeah.
chart that just shows versus historical averages, and we're definitely at the lower end of that.
Hmm.
Um, and our expectation is at the same time, you spreads should have tightened anyway because corporates have cleaned up their balance sheets. It is an attractive area to
Hmm.
invest in. But at the same time, if you're trying to avoid just the risk of defaults,
Hmm.
and the spreads are a couple hundred basis points tighter than they have been historically.
Gotcha.
So that's what we look at is just um, like I guess I should step back, and that is, let's just say you have a 60-40 allocation, 60% equities, 40% fixed income. There isn't really a need to change that, right? That's something for the long run. When you look within fixed income,
Hmm.
right now, it makes more sense to uh, move up in quality, and that's what we've done. Does that mean we don't have exposure to traditional credit? No, of course we do. It's really just that on the margin, you start to reduce that exposure, trim back holdings that you think might not
Hmm.
be compensating you. And then the dislocations themselves give you that opportunity to jump back in.
Gotcha.
And oh, go ahead.
No, no, go ahead.
Uh,
Didn't.
I was going to give you one
Yep.
more example of just a dislocation that happened during the
Yep.
financial crisis. Um, so I don't know if you or your audience, if you remember the Big Short,
Oh yeah.
Michael Lewis book
Oh
and the
yeah.
movie.
Yep.
So if you go back to that book or the movie, there were mortgages and there was a lot of leverage, and they were issued by banks and financial institutions, mortgage companies as well. And really there was a lot of leverage in that market. We were really staying away from that part of the fixed income market. We just thought that it was a little bit too frothy. And then the financial crisis hits. And the dislocation that occurred is all of those securities were priced as though everyone was going to default on their home loan. And our view, and we'd done a lot of analysis on it, was when you have a security that is collateralized by 1,000 home loans, not all 1,000 will default, but we didn't own those securities. And so the prices of those securities during the financial crisis dropped from 100 cents on the dollar to 25, 30 cents on the dollar. And doing our analysis, we thought, okay, here's a dislocation. That's just it can't
Hmm.
drop to pretty much zero. So this was an example of then we started buying these securities. They're called non-agency or non-government guaranteed mortgages, and again issued by banks and financial institutions. And our view at the time was we're probably going to make some money. There will be some defaults,
Hmm.
but if we're paying, let's say, 35 cents on the dollar, and they appreciate, we'll make money for investors. And sure enough, over the last 15 years, that's what's
Hmm.
happened with those securities. So I don't think you'll have that kind of extreme situation
I would hope
on the
not.
one. Yeah.
Yeah.
Um, it- but on the other
Yeah.
hand, um, if you see again spreads widening out to historical wides or above historical averages, that's when you'd say, okay, this looks interesting.
What do you think something that could cause that could be? Is could it just be, we enter a period of time where companies get lazy and they let their balance sheets, sort of, degrade in quality? Or is there an event that, you could see, we don't need it to be to the magnitude of the GFC, but is that something that you think would be more likely to cause something like that? Or do you think it would just be, you know, could just be certain market conditions, companies getting lazy, making some bad choices, stuff like that.
Yeah, I think you know, it's expect the unexpected, I guess would
Hmm.
be, that I, based on my experience, I would say the GFC was, I don't know that it was a once in a lifetime event, but there's definitely more scrutiny. There were regulations that were put in place that should hopefully help us navigate so that you don't see an event like that again.
Right. Right.
I'd say for most companies, it's really just, they've cleaned up their balance sheets. They look really strong. That's not the issue. It's more along the lines of what happens to the global economy.
Hmm.
And, there are some businesses that they may be smaller businesses that are undercapitalized. It's not that they're lazy, using that term. It's just it's a business model that's not going to work.
Hmm.
So, that could be one instance of it. Another would be that there are just shifts in consumer spending
Hmm.
and shifting away from certain areas of the market. Examples would be if you look at what Amazon has been able to do and then you look at some of the brick and mortar stores that have had to close down, that would be an example of either they didn't adapt to the environment
Hmm.
or, the business model has just changed um, they have to adjust and
Hmm.
make changes. Uh, then the pandemic actually, for restaurants and for many for pharmaceutical or for brick and mortar companies as well. The pandemic caused issues. That's again, it's more of like a once in a lifetime event versus did they have the business model wrong?
Gotcha. Gotcha. No, that makes sense. I think that's a great way to look at it. One thing I always touch on is how U.S. companies are so good at adapting and navigating and moving with the current market environments, where regardless of what it might be. Um, I sit across some clients and I tell them, not only are you just investing in, financially some of the best companies in the world, but you have management teams and executives and managers, working all day to just grow that company, right? They're basically working for you is a way that you can think about it. Because their job and what they get paid for is to have the company improve. And a lot of people don't think about it that way. And it's the same for investing in their debt or bonds, as it is for their equities when you think about from the company point of view.
Yeah, and it's interesting because you do have a different lens for equities versus bonds
Hmm.
or fixed income. With equities, it's is this company growing? Is it growing at a pace where the equity price would increase?
Hmm.
That's more what you're looking for. With fixed income, this is where we're contrarians in the sense that you're all basically you just want to get repaid.
Hmm.
And so what we're looking at, even if it's a business model where you'd say it's a well-established company, the growth rate isn't going to be double digits, but it's a really solid, strong company. They've done all the right things and management's really good, and they'll repay us, and the bond yield is attractive, then that's that's how we would view it. And so it is a slightly different lens, but as again, as contrarians,
Hmm.
you're just looking at, we, hey, economic growth or growth for that company would be fantastic,
Hmm.
but it's really just, do they have solid fundamentals?
Quick side question: do you think, I'm not going to ask this in the best way, do you think it might be easier from that point of view to be a fixed income investor in some ways, right? Because all your, to your point, what you could be, looking for is just, is this company going to pay me back, right? The management's good, they have a good balance sheet, the odds that I'm going to get paid back are pretty high. Rather than, if you look at it from, an equity standpoint, now you have to think about, the market landscape, how, appetite for risk. You have to think about earnings growth, all these different things. Do you think it could be, being a income investor from that standpoint could be, could be more simple? Not the best way I'm asking that question.
No, that makes sense. It's yes on the one hand, and then no on the other hand, and I'll tell
Hmm.
you why.
Yeah.
As we're investing today, so we've moved up in quality. We're investing in actually we have exposure to corporates, and so
Hmm.
the answer is even with a corporate, uh, it's still complicated because you have to understand their financial statements. Uh, if they're highly regulated, then there's more comfort in the numbers that you're seeing. And this is where I know at some point we'll touch upon emerging markets, but
Yep.
let's just say it's an emerging market uh, company or even a government bond. There isn't as much, you really have to be on the ground. It's more difficult to trust all of that information. And so you need to get different sources of information in order to
Hmm.
make the evaluation. So it can actually be really challenging and complicated. We also do a lot of quantitative analysis just on our portfolios
Hmm.
in terms of different scenarios. Um, it's sort of like just because, let's say, a security is a good security, what about the economic environment? And what if you have a sell-off, a flight, or a flight to quality? What happens under those circumstances? Do you have the
Hmm.
right mix of securities in your portfolio? And where we've tended to shift is to the what I call the structured credit market. What does that mean? Structured credit includes residential mortgages, commercial mortgages, asset-backed securities. These are securities that have underlying collateral. So
Hmm.
they're not tied to a specific company, but it would be like residential mortgages, sort of like the Big Short, you know.
Yep. Yep.
Um, and but that's where it gets a lot more complicated because you have to understand what is that underlying collateral. And if it's a residential mortgage, did the bank or the financial institution do really solid underwriting? Do they have a good servicer? Let's say somebody is late on their mortgage payment every month. The servicer has to step in and force them to pay.
Hmm.
So that's where it ends up being really complex. Um, when you're looking at emerging market countries, it's not only just the government or the corporate or what we call quasi-sovereigns, which are corporates that are government owned essentially. It's not only that, but you have to take politics into consideration. Could the political environment change? Is there unrest and upheaval? And you want to get compensated for that. So that can be complicated. With municipals, it's a slightly different view.
Hmm.
Are these, let's say, to simplify it, are these government obligation bonds, which basically are issued by a municipality or state, and tax revenue pays you back, or is it a revenue bond? And a revenue bond could be a toll road. Is there enough traffic going through? So you're not getting compensated necessarily by the taxes, but you're getting compensated by the volume of cars that are going through the toll road. Is it an airport? And if travel picks up, then it's more the revenue that's being generated from that. So
Hmm.
again, each area ends up having its own complexity.
Hmm.
And that's one of the reasons that we have so many resources dedicated to each of those areas, because I'd say it's simple when you're in, that part of the market. It's complicated when you're managing a portfolio and you can invest in all of those different
Hmm.
areas and you need the resources. And then one additional piece, which a lot of people don't know, the size of the fixed income market is nearly double equity market.
Yep.
And you can where it becomes complicated. So let's say it's a residential mortgage issued by one of the agencies, like Fannie Mae, as an example. They issue different, they securitize all of these home loans. They issue different coupons. You have the evaluation's complex because you have 1,000 underlying home loans, and you don't know that's 1,000 different families or households, uh, versus one company.
Hmm.
And so
Yeah.
that's it becomes really complex.
Yeah. People don't, to your point, people don't realize this, the magnitude of the fixed income market and how big it really is. Um, I feel like oftentimes people just think, okay, there's T bills, companies issue bonds, but then they don't realize, municipals, which is what we'll go to next, um, emerging markets, whatever it may be. So it's a massive marketplace, and that adds to the complexity.
Yeah, it really is. It can be complex. The one thing I'd say, regardless of what's happened with all the volatility more recently, generally, when you compare fixed income today versus, really, you have to go back 15 years ago to the
Hmm.
financial crisis. Fixed income is attractive in the sense that starting yields are high. And in a portfolio today, you can earn 6 to 7% in a well-diversified portfolio. Valuations in many of the high quality sectors that I described are attractive as well. And so that really does help. Um, Risk assets are priced kind of rich, like credit spreads. At the same time, that also means that there's opportunities going forward. And generally we're back to that relationship of high quality fixed income is a great diversifier, low correlation to
Hmm.
equities. And for the most part, what you'll find is you're going to see the future returns with, like, if you just represent, nothing else happens, and you invest in a portfolio that yields, let's say, 6 to 7%,
Hmm.
correlation is really high going forward, that that's what you would earn going forward. So that's the one thing about just generally with fixed income. That's what, when I first started here, that was the relationship. And then, that all changed with the financial crisis. It changed once again with the taper tantrum in 2013. It changed again with the pandemic. But at the same time, we're back to what I'd say are, let's say, more normal yields
Hmm.
and more of a normal relationship.
What is certain is that things are always going to change, and nothing's always going to remain the same.
That's right.
So we touched on municipalities briefly, and I think you did a great job of explaining, the different types of municipalities that exist. One question I have for you in particular, would just love to understand. So you're based in California, in Southern California, and I know you and I briefly talked about this, but how did the period of having the wildfires? How does something like that, like a natural disaster that can't be really avoided. How does something like that affect, the municipal bond market for bonds in that area?
Yeah, so the interesting thing there is if you look at default rates and credit quality in the municipal market,
Hmm.
default rates in, let's say, high yield munis are so that would be double B rated and below are similar to single A credit. So default rates are really low. And the reason for that is that most municipalities and states have some kind of government backing. They also have flexibility, so they can adjust the tax revenue. They can, there are times, let's say it's a state like California, there are some programs that uh, are optional in the sense that the governor or the assembly can say, hey, we're not going to spend the money on those programs. So you have more flexibility versus a corporation. A
Hmm.
corporation can cut expenses or cut salaries, but that doesn't necessarily lead to a revenue increase. So from that perspective, when you look at municipal bonds, versus a traditional corporate, there are some levers that a municipality or a state has that can, change the profitability, even though they're not there for profit.
Right.
With the wildfires, our view was the one potential based on what's happened historically with wildfires. The one uh, this wasn't our base case, but the one potential risk was that the LA Department of Water and Power, there was the possibility that if they were, held accountable for some of that risk, that could drop the price. It wouldn't necessarily lead to a default by LADWP, but there's just that risk that um, that prices fall. And so we looked across our portfolios, and this is one benefit that we have where we can look across our portfolios and we can implement programs to, make some shifts and either reduce or increase exposure to different bonds, and we were able to do that. But what we did was we evaluated the local municipalities or Department of Power, power companies,
Hmm.
and made some decisions about where are the potential risks in our portfolio, even though we know that there's enough federal support, there's enough support from the state where we wouldn't expect a default on those bonds, but there's just some risk, and some of it's headline risk, some of it's price risk, where you can trim some of that back. So that's part of the evaluation that we would do. Um, Generally, in municipals, our view broadly is similar to what I said about fixed income broadly, and that is yields are high and attractive. The valuations today are very attractive, and there are investors that are taxpayers, and for them, it's a huge benefit to invest in municipals. Using California as an example, if you were in the highest tax bracket, both federally and state, it would be a 52% tax because the federal tax rate's about, I think it's 38% or 39%. And then the highest tax rate in California is 15%. So if, let's say, you invested in a high quality municipal portfolio that was yielding 4.5%, you could almost double that. And where are you going to find a 9%
Hmm.
yield in taxable space? So that's really, for many investors, that's the benefit of municipals.
So what you just described was what's called the tax equivalent yield,
Right.
right? Okay.
Yeah.
Yeah.
Because basically you're not getting taxed for it. So if the tax equivalent yield would, or exactly. So you'd have to find a taxable security that you get taxed on that's earning 9% in order for that to be break even.
Man, 52%. That sounds fun.
Yeah, it's definitely a high tax state.
Yeah, but it's worth it. I've told you many times. I love it out there and it's beautiful in Southern California. So it's in many ways it's worth it. Um, One thing that I thought of, so in a situation like the wildfires, do you see bondholders making emotional decisions like selling bonds and to the public markets just like you would like an equity investor, right? When times are uncertain, they get emotional, they make emotional decisions and sell things. Did you see supply tick up in that environment?
Yeah, so we definitely got questions and requests. In some cases, when we evaluated the portfolios, we were able to go through line item by line item and say, here's our base case. We think that these are solid names in the portfolio. There are some where you'd say, yeah, if you're a long-term holder and you're looking for that tax benefit, then it may not make sense to sell the bond. But if you're not comfortable holding one of those bonds, then it's not a problem. And the other thing is in this kind of environment, because yields are reasonably high, there's it's easier to make that substitution.
Hmm.
And so
That's a
there are
good
other
point.
municipal bonds that you can buy, and so that as we were looking at our portfolios, um, it did create an opportunity to
Hmm.
make some shifts in our portfolios just based on risk taking and valuations.
That's a great point that you made. Just with all yields being in a similar range, right? All roughly around the same spot. You can swap from one to the other, keep quality the same, right? Not take more risk and still get the same outcome.
Yeah, and it just going back a couple of years, one of the things that we saw and what we were doing, we'll call it tax loss harvesting, but we were doing that where um, clients were asking for that.
Hmm.
And again, they're focused on their taxes and minimizing them as much as possible. And so there were securities where um, essentially because of that increase in interest rates, um, you were trading out of a security at a lower yield. You were taking a modest tax loss, which actually was a benefit for some
Hmm.
investors, and they were trading into a higher yielding municipal bond. And so we did that with many of our portfolios, and it was a benefit for investors.
Yeah, for sure. No doubt about that. Let's talk about emerging markets real quick. Um, that's something that we've used this phrase a couple times, but emerging markets, fixed income really doesn't get a whole lot of attention, especially over the past couple years, with emerging markets not being the best place to be as an equity investor. And some now we have some tension with countries overseas, and there's geopolitical stuff going on. There's a whole bunch of things that we can list off, but let's touch on emerging markets real quick, and as a starting point, would love to just hear what your overall viewpoints are, and how you guys are viewing a market like that.
So emerging markets, I would say the perception for most people is that emerging markets, you're taking on a lot of risk. And in emerging markets, you have equity markets and fixed income markets. We focus on fixed income. My experience there has been that really the fundamentals have improved in the emerging markets over the past few years.
Hmm.
And it's similar to what you're seeing, let's say, in corporate America and really just across the board, where you're starting to see more reserves, more capital set aside by governments. Then what you have to do is just look at uh, political stability or instability. And so that's usually where there are some countries where we'd say, that we're just going to avoid them for that reason. You also have to look at issuance. So there are countries like Brazil, Mexico, South Africa, India, where you are seeing a fair amount of issuance. And so they're what I'd say are reasonably liquid markets. And those markets are fairly well built out so that you can invest not only in the government bond, you can invest, so the sovereign bonds, the quasi-sovereigns, and I can give you a couple of examples there.
Sure.
Most notable would be in Brazil, you have Petrobras, which is one of the largest oil companies in the world. In Mexico, Pemex, similar.
Hmm.
And so, and then you have emerging market corporates. And where we tend our habitat, let's say, where we tend to invest in is we'll look at the more liquid countries where there's more bond issuance, where there's reasonable political stability, and where the fundamentals seem to be strong. What's also happened over the last few years, and this is been my experience, and when you look at some of these countries, they were well ahead of the Fed and other developed market countries in terms of raising rates to fight inflation. And a couple of years ago, as an example, I was in Peru and they had already started cutting interest rates. In Chile, they had already started cutting interest rates just because they had already had that inflation battle, and then they needed to provide stimulus to their economies. So generally, those are the countries that you would see in a broad multi-sector portfolio. And then in our emerging market portfolios, that's where you're managing versus a benchmark. So there it's either underweights and overweights. You will have exposure to most countries within the benchmark. However, there are some that you eliminate. So it would be like you wouldn't see, let's say, a bond from, well, Ukraine would be an example. As
Right,
much
right.
as you know, as much as we'd like to, or and Russia would be another example where with Ukraine, as much as we'd want to support them, with Russia, it's really just the political situation
Hmm.
and the uncertainty there. So
Right.
there are going to be bonds that we want to own.
Makes total sense. When you say the fundamentals of a country, do you I would assume you don't mean like the balance sheet of the government, right? Because when you, for example, you look at the U.S., right? The U.S. runs at a deficit every year. From that perspective, you don't want to buy bonds, right? When somebody's losing money every year. But so what I would assume you mean is you look at sort of like the demographics of their society, right? And take a country like India, for example. Um, they have the country's doing really well. Earnings are continuing to rise for the average citizen. The biggest population on the planet. Is that sort of what you mean when you say the fundamentals of the country?
It's a combination of that, and then overlay that with politics. With in India, as an example, with Modi, there's more political stability there. And then you also look at what about GDP growth? It's reasonably strong.
Hmm.
Inflation is relatively under control. You haven't seen a significant spike in prices. And so that means that they have that. It's never going to be perfect,
Hmm.
but they have that ability to repay the bonds. And that's really the key. Or if it's, let's say it's a company like Pemex, then you have the government support. Really, you're evaluating that security more like a
Hmm.
corporate bond. And, what about revenue, profitability? And so it's that combination of, is it a sovereign where, you're looking more at the country itself and
Hmm.
the characteristics of the country versus a quasi-sovereign, which is a corporation, and it may be partially or fully owned by the government.
Hmm.
You still have to get compensated for the political risk, but you can evaluate it like a traditional corporate.
Gotcha, gotcha. When you're looking at portfolios right now, are you looking at the emerging market space as something that you guys might want to add to, or do you think you guys are comfortable with the amount of exposure that you currently have to emerging markets?
It definitely, we're looking, in this case, we're looking more for just dislocations where spreads widen out and you're getting compensated for
Hmm.
the potential risk that you're taking. So the answer is we're comfortable today. We've reduced in multi-sector portfolios, like our income strategy as an example, our total return strategy. Those are kind of the emerging markets you'd call a plus sector just because
Hmm.
the yield is higher. We've reduced our exposure over the last couple of years.
Hmm.
And that's just because of the general risk associated with the global economy and broad economic slowdown
Hmm.
global. at the same time, we are looking for opportunities within emerging markets. And when things start to settle down, you start to see normalization in economic growth. You see inflation under control more broadly, and the global economy is starting to pull back out and GDP growth growing. That's where we would definitely increase our exposure to emerging markets.
Gotcha. One thing you touched on was the income portfolio. And I think one thing, we'll finish up here with is, in 2007, that was actually something that, you co-founded, right? In 2007, the income portfolio. Would love to, hear a little bit about that process and how you got, what the genesis of that was.
Yeah, it was actually really interesting because I'd been focusing on the front end of the yield curve at the time, so our short duration strategies. And had spoken to a number of financial advisors and then worked with our global wealth management team. And there was just a gap in our lineup. So we had our flagship strategy, our total return strategy, that didn't quite have the yield or distribution that end investors were looking for and advisors were looking for.
Mm-hmm.
We have credit strategies. High yield probably would be the best example of that. But financial advisors again said, well, yeah, the yield's high, but that's taking on a lot of risk. Is there something that kind of falls in between? And what I did was worked really closely with Dan Iveson, Alfred Murata, Josh Anderson, and we came up with this idea of investing in a globally diversified strategy that was flexible with that primary objective of paying out a consistent distribution. But secondarily, it's not just distribution, secondarily, focus on capital appreciation or, I'd say it's almost like capital preservation in environments where you think that fixed income markets are selling off and you just want to minimize that.
Mm-hmm.
And anyway, so we were sitting on the trade floor and just discussing could we create a strategy that kind of, I'll call it, fell in between. And the income strategy is what we came up with. And it's developed over time. It's a strategy where we do have that global opportunity set, which is about 130 trillion in size, which kind of amazes me when I think about the size.
Mm-hmm.
And we're able to invest globally and we have flexibility and we've been able to achieve those two objectives. But really it was a collaboration with financial advisors. I'd love to say I was totally creative and it was, my idea. But really it was getting input from financial advisors, from their clients, working closely with them to come up with a solution, and then working with our portfolio management team to create a strategy that we could manage, that fit within our process and philosophy.
Gotcha. And it's, to your point, it's become, one of the the portfolios that you guys are known for. Um, and it's, the super interesting piece about it is all that flexibility, right? So, combination of, correct me if I'm wrong, government treasuries, corporates, um, I don't know, maybe some municipal stuff in there, um, and all emerging markets, other developed countries, all that together, sort of in one pot, and you that's sort of the objective, right? Is to take, I guess, the best of everything, and sort of put it together.
It's having that flexibility, looking at relative value. That's
Mm-hmm.
really important as well. It's an example that kind of fits into this environment is that we've started to allocate a little bit more to Treasury inflation protected securities. Inflation has been a huge client question that constantly
Mm-hmm.
comes up. So we've been able to do that. But yes, it's just having that flexibility and being able to navigate throughout different economic environments.
Gotcha. That's fantastic. So it's been a pleasure to hear your insights and learn from one of the best in the business. So thank you so much for taking the time.
I appreciate it. It's fun.
We're gonna do another hour if you're okay with it.
Oh, okay.
One of the one thing I always like to finish up with is some a quick insight. Just would love to hear one thing in your career that's stuck with you. Could be a quote that somebody said to you, or just a phrase that somebody's taught you, or something that you've learned along the way. Would love to hear what that is from you, and then we'll wrap it up.
Okay. No, that's great. And yeah, we could probably go on for another couple of hours.
Yeah, we could.
Next time you're out in California, stop by.
Yeah.
Um, so I actually have two things, and really I had one, and then yesterday and today I kind of came up with a second one just because of the environment. So I'll start with that one. Um, and it's really just expect the unexpected. Don't be surprised by surprises because it's going to happen to you whether you're an investor or it's going to happen to you in life. And so, you can always have a base case for what you believe. And again, it's like your expectations, in life, this is what I think is going to happen. Or, uh, when you're investing, it's you have a base case, but it's always look for the outliers. And it kind of learned during the financial crisis, during the taper tantrum, during the pandemic, but it applies today because I really did think that, and many of us thought that there would be some kind of negotiation with political situation today. But really, the one that I had originally kind of has always stuck with me is it's really the team and team chemistry. You can't get it done, you can only get things done by having a team. You can do a lot by yourself, but really you need to be able to collaborate and work with a broad range of people. And what I learned early on, and this is from a mentor, um, what she told me was when you're building out a team, it's bringing the best candidates with the highest potential because their success is your success. And there are a lot of people that I've seen over time, it's like as they're evaluating talent, they're like
Hmm.
threatened by somebody because they think, oh, they're smarter. But I viewed it since then just more along the lines of, hey, this is somebody that can be successful, and in some cases I can mentor that person and then they can have a career that's incredibly successful. That we all benefit, but the one caveat to that is team chemistry. So just want to make sure as you're talking to people and building out that team, and you could use a sports analogy, you could have a team with, let's say it's a basketball team with four superstars or five superstars, but they don't have any chemistry. They're the best of the best, but they don't work well together. You
Hmm.
want to make sure that, you have a team that really provides just the chemistry so that you're all working towards that same goal.
I think that's something that in life is underestimated, and in career it's underestimated. Is getting people around you, or putting yourself in a group with other people that have the same goals, objectives. It can really ramp up. Where you guys are going to get to, rather than just you doing it yourself.
And it sticks with me today. And going back to your question about PIMCO and what I like about it is you have so many personalities, but we all have the same common goal and objective. And the one thing I always strive for is just work well together, and we can create success for everybody and solutions for clients.
Hmm. I think you guys have done a great job with that. So
Wow.
let's thank you, Paul. It's been a pleasure to speak with you. Look forward to doing this again in the future. Hearing what you guys have to say, it's fantastic, right? You guys have some of the best insights out there. If there's anything that we want to learn about the fixed income markets, right? You guys are who people can learn from the best. Because that's your bread and butter, and that's what you guys do. So, thank you so much. It's been a pleasure speaking with you, and thank you to the listeners for tuning in. And we appreciate the feedback. Please feel free to like and subscribe, and we'll see you in the next one. Take care.
Thanks, Michael.
Thanks, Paul.
Sharp Minds is produced and hosted by Michael LaFata and directed and edited by Alex Weimer. Our music is made by Tony Sapiato and licensed through Soundstripe. Michael LaFata, Financial Advisor, Archstone Financial, 508-453-9800, 324 Grove Street, Worcester, Massachusetts, 01605. Securities and advisory services are offered through Cetera Advisor Networks LLC, member FINRA, SIPC, a broker, dealer, and registered investment advisor. Cetera is under separate ownership from any other named entity. Archstone Financial is not a subsidiary nor controlled by Cetera Wealth Partners. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks LLC and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results. The guest speaker interviewed in this podcast is not affiliated with or registered with Cetera Advisor Networks LLC. Any information provided by them is in no way related to Cetera Advisor Networks LLC or its registered representatives.
All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. The return and principal value of bonds fluctuate with changes in market conditions. If bonds are not held to maturity, they may be worth more or less than their original value. Additional risks are associated with international investing, such as currency fluctuations, political and economic stability, and differences in accounting standards. Money market funds. An investment in the fund is neither insured nor guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve your $1 per share, it is possible to lose money in the fund. Municipal funds. Investors should consider their investment objectives, risks, charges, and expenses associated with municipal fund securities before investing. This information is found on the issuer's official statement and should be read carefully before investing. Mutual funds. Investing in mutual funds is subject to risk and loss of principal. There is no assurance or certainty that any investment strategy will be successful in meeting its objectives. Investors should consider the investment objectives, risks and charges, and expenses of the fund carefully before investing. The prospectus contains this and other information about the funds. Contact your financial advisor to obtain a prospectus, which should be read carefully before investing or sending money.